Good afternoon, everybody, fellow investors. Welcome to the October 19th bull session. We continue our Oktoberfest celebration. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and Ken Kavula has returned from his sojourn down to the southeast. Welcome back, Ken.
I'm glad to be back. We had a wonderful time in South Carolina, but it's always nice to sleep in your own bed, Mark, I'll tell you.
Absolutely. Roger that. We're also joined here by Kim Butcher. Kim is actually in a construction zone, so she may be muting herself more than usual today. Sounds quiet for now, Kim.
Yeah, it's quiet now, and I'm here, and I probably should take my Tylenol now because you don't know how long the jackhammer is going to go on.
All right, and it's time to do the lederhosen check. Sean, are you wearing the lederhosen today, or did you leave them off again today?
Today was a got to show up to work day.
Oh, okay.
And unfortunately, I don't work for a German company, so.
Well, welcome
Do you have
back.
to go to an office, or can you just do it at home where you could wear those lederhosen?
Well, I have to go into the office twice a week, and today's my day to be in the office. So.
Okay, well, welcome back, Sean. For those of you that Sean is a new name, he's been more active at some of the stuff we're doing at Manifest Investing, and I expect you can look forward to him being in some type of a producer role in the future. So thanks, Sean. Appreciate it.
Sean, what model club are you associated with now?
Over here with the Pennsylvania chapter.
In
middle
Pennsylvania?
Yes, middle Pennsylvania.
Okay.
Yeah, the one that we visited in Harrisburg or thereabouts.
Right, with Ken Mobley, right?
Yes.
Yeah, okay.
Yeah, and we look forward to probably rendezvousing with Sean in Punxsutawney at some time in the near future.
Oh, I will be there.
All right.
I will be there. Anything
That's
to...
a story we don't need to waste time on right now, Mark.
No, we don't. All right, here we go. We're going to talk about a different kind of red October. Now that the St. Louis Cardinals are out of the baseball playoffs, good luck to the Atlanta Braves and Cy Lynch. But we will talk about a different kind of red October. Then we're going to continue our trek down the path of trying to find promising, high-quality, smaller companies, and that's basically where we're going to spend some time here today. We get serious now. This is, Ken, I consider this the 2 weeks of full court press.
It's the home stretch, and
yeah.
What's interesting, Mark, is that you get them kind of on a slide, and you kind of gave them a push at the top now, and they're going to gain momentum as they go down that slide. And they're going to be harder and harder to dislodge from the list as we approach that October 31st deadline.
Yeah, I think I looked at like 40 companies today.
Yeah.
And not a single one of them threatened the list. So
I haven't been able to give you even a good candidate probably in the last 4 or 5 weeks. So
that's promising. In the last picture there on the right, that's a tip of the cap to Sean, and Sean has messed around with the guys on Reddit, and many of them refer to themselves as apes in the investing world. And just yesterday, there was a statue of an ape in the presence of the bull on Wall Street. So you may have seen
If you look closely there, he's surrounded by a bunch of bananas too. That bull is. Yeah,
the bull was actually neck deep in bananas. And I'm told, for those of you that are concerned, that the bananas were rounded up and they were not wasted, and they were given to social agencies to take care of the homeless and people who actually consumed them. So there you go. All right, enough messing around. Here's the boilerplate standard disclaimer. No investment recommendation is intended. This is all about education, where we're trying to demonstrate the philosophies, methods, techniques, and generally what we believe in the modern investment club movement. Everything's for illustration. Please do your own homework. What you will be hearing is our opinions about our interpretation of that 8 decades old successful journey in investing, as we interpret that at Manifest Investing. So please keep that in mind. But again, please do your own homework and make your own decisions. If we do hold a stock that we're talking about, we try to remember to disclose that. We do a monthly roundtable. We're 1 week away from that. It's a night evening broadcast. It's generally the final Tuesday of every month at 8:30 Eastern Time, and referred to as the Roundtable. If you'd like to be added to a reminder about that particular event, it is now 11 years in the making. We did just top a 19% internal rate of return on the selections we've made. So once again, we're grateful for that. But if you'd like to be added to the reminder list, send an email to nkavula1@comcast.net. And then Ken will be talking about in a few minutes the workshops that we're going to be doing, their webcasts on November 10th and 11th. And if you're here today, you're probably going to get an invitation to that series of webcasts. And if you don't, you can also send an email directly to Natalie at that email address, nkavula1@comcast.net, if you can't figure out how to get registered for those November webcasts. Anything you want to add to that, Ken?
Yeah, Mark, they should have already received our first publicity blast from the Mid-Michigan chapter. And if you didn't get a fairly long email outlining the classes and talking about the how you register for them, send just a brief note to Natalie. She'll send you out a copy of what we already sent to our guest list. And then if you're not getting the stuff right now and would like to be added to our guest list, put that in the email as well, and we'll be glad to add you to the guest list. And that way you'll get our reminders. We only send out one a month. And when we're doing something special like this conference in early November, we might send out 2 things that particular month.
Okay, and if you would like copies of the slides, or if you have follow-up questions or suggestions for future topics, including one of those sessions, as you'll see in a few minutes, is we're going to redo our 20 questions on investing and investment clubs as one of the sessions. And if you have a topic that you'd like to kick around for that, please send that to either Ken or myself. My email address is on the screen, markr@manifestinvesting.com. All right, so let's go ahead and get underway. Here's the bullpen, our queue of upcoming topics. No real major changes this week. We do want to spend just a couple more moments with Brian Feraldi and this notion that we covered last week. It's been a while since we got such favorable feedback. Well, we always get favorable feedback, but we got really strong feedback on the concept presented by Brian. So we'll spend a few minutes talking about that, and then we're just going to basically launch into our best small company hunt. And we will be coming back to the other sessions that you see on the screen, but we're going to wrap out October, including next week, and probably the session after that with the hunt for those best small companies for this year. All right. Thought I'd spend just a moment because I was reminded this past weekend of Alan Abelson. He passed away several years ago, but Alan used to be pretty prominently featured in Barron's magazine. And it just serves as a bit of a reminder as to what can go wrong suddenly in the stock market. And we should never lose sight of that. This happens to be the 1987 single day crash where the stock price basically went from 14-ish down to 10-ish in a matter of minutes. And fortunately for me, that's kind of before I got heavily into investing. Ken, you probably remember it a little bit better.
I remember it vividly, Mark. My father-in-law had just passed away. He had left a large number of different companies to his daughters, 3 or 4 or 5 shares each of about 100 different companies. And we were watching the value of those things, and they were at a certain amount one day, and that took a huge haircut. And we didn't even own any stock at that point. They were still in limbo being transferred, but they had already lost about 40% of their value. So it was a brutal lesson to learn as a novice investor, I'll tell you.
Yeah, and we don't put this up to frighten or anything else other than to just remind that stock prices fluctuate. And as you see on the lower right there, over a period of a month, the stock price in the stock market as measured by the Value Line Arithmetic Index basically went from 300-ish down to 180. That's a drop of 40, 50%, just over the course of a month. So it can happen. We're not saying we know that's going to happen. We don't believe anybody can predict when that will happen. But what we do know over the long term is that if you invest in excellent companies and you buy them when they're on sale at good prices, you can basically take some of the shock out of that type of a situation, whether it's 1987 or 1998 or 2008. Anytime we've gone through an excursion like this, I mean, it's really great if you happen to have some cash that's parked on the sidelines and you can go shopping like crazy. But the other thing is, for the holdings that you do have in your portfolio, you do want to make sure that you have the core portion of your portfolio properly positioned in high quality stocks. It'll take the edge off of any one of these type of excursions. And
I also think it keeps you sane, Mark, to discuss these kind of things with people that have been investing for a while, that have lived through some of these really severe drops in the market, and that puts some perspective to a 200 or 300 or 400 point drop in the Dow from Monday to Tuesday that recovers on Thursday. It puts some perspective into the whole concept of stock prices fluctuate, but we ain't seen nothing really in the last 18 months that would qualify as one of these bear markets. We've seen some stocks correct like that, but the market as a whole has remained persistently resilient, is a nice way I would term it.
Sure. And the other thing is, a couple things that I would point out, this drop on this particular day that is shown here, it's huge, right? But I also want you to notice that it came back quite a bit in the next 2 days. And so there's a couple of things that I want to remind everybody about. I mean, don't forget that that's there. I mean, there's no reason to go up to the roof and think about jumping off on Monday evening when you're going to get it's not unusual to get a 20 or 30% bounce back the next day. The other thing is Hugh McManus shared a number of YouTube videos of Louis Rukeyser talking about the situation back then. In fact, the night of that drop, Rukeyser put out a show on PBS, and I'll actually add the links to those shows on the notes in the forum. But just keep your head about you. Go home and hug the people who love you, and everything will be fine if that day ever presents itself again. All right, let's go ahead and press on. Ken, I invited you to take a look at the sessions from the last couple of weeks while you were off sitting and putting your toes in the sand and drinking adult beverages down on the Atlantic Ocean.
Well, I was doing one of those two things, Mark. So
okay. I'm gonna rule out the sandy toes.
Bingo.
But we actually covered this session last week. Sean and I spent some time with it along with Kim and Matt Spielman, and we did receive a bunch of feedback on it. Some of them are up there at the top. I'd love to hear your thoughts on, since you were playing hooky, some of your perceptions about it. I'll go ahead and go to this slide and give you kind of a stand back. And what do you think?
Well, I really do value PE when the market is well behaved, when the company you're looking at is well behaved, because it does allow me to compare well-behaved companies and well-behaved industries to other well-behaved companies and well-behaved industries. But I think trying to point out well-behaved anything in the last 18 months, for example, is a fool's errand. PEs have moved all over the place, and we know why they've moved all over the place. It's in the calculation. PE depends on earnings. That's the denominator of a fraction. And when the denominator of a fraction approaches zero, the fraction itself takes off and it skyrockets. So that when you're looking at PEs of 100 or 200 for a company that had most of its earnings disappear for a while, you shouldn't be amazed, and you shouldn't use that as a gauge to buy or to sell. When you're looking at companies that are just starting up and that have little or no earnings, I get the question all the time. I really like this company, but there's no PE. Well, there's no PE because there's no E. There's no earnings. And I hope most of you learned in third grade that you can't divide by nothing. You can't divide by zero. It's an exception to the division rule. So I like this graphical breakdown. I believe it represents my thinking very closely as to what I consider core and what I consider non-core. The only thing that I might do is make the overlap a little bit bigger between the two, because I think there's a very broad category that for want of a better term, it's gray in the middle. And it's gray in the middle because to some people, the stock is definitely core, and to other people, the stock is definitely non-core. I think Amazon is a great example of that. Mark and I have talked a number of different times about how you could make a good argument in either direction for Amazon. I like that, Mark. Yeah, I like that a lot. But other than that, I wouldn't be afraid to take that non-core all the way down to, just the right-hand side of zero. Because I think that a lot of times when a company has good, consistent sales growth, that you can look at it, you can ask yourself, what is it doing to the industry that it's part of? Is it breaking into an industry as a competitor? Is it breaking in as a disruptor? Why is that company doing so well in selling its goods? And then you can begin to project that when it does become profitable, you might have yourself a giant home run on your hands. We've talked many, many times in these sessions and in many other sessions about how you don't have to hit a whole lot of home runs in your investing career to have a really nice, consistently growing nest egg. You can strike out an awful lot. And as long as you've hit those home runs, occasionally your nest egg will keep to the positive side, and you'll be happy in retirement. So I don't see anything really to pick at this picture. I like it a lot. I certainly agree that top line, that revenue line, represents a typical company. We might quip a little bit or bicker a little bit about the fifth section there, Mark, in the decline, because a lot of really good companies, they don't actually decline, but they plateau out, they stay stable, or they reinvent themselves and start that curve all over again. I think Apple is a great example of a company that's reinvented itself 2 or 3 different times from what its core business used to be. Yeah. I mean, think about it. The Apple that I owned in 1980 is nothing like the Apple that I own today. Nothing at all. So, yeah. But generally, I like the graphic. I like the concepts that it's talking about, and I think it makes the point that you can't just look at a PE and say good stock, bad stock.
Yeah, and I think Brian Feraldi actually covered that that fifth stage is not inevitable. There are companies that have been around for 100 years or more that basically defy that and produce something that's well ensconced in the Maslow hierarchy of needs, and so they stick around. And chocolate, for example. So yeah,
and laundry detergent.
And laundry detergent's a good one too.
Yeah,
it's a good thing. So yeah, the only other thing I would add is that Brian left out price to cash flow, which we have always talked about as maybe a bridge between 2 and 3. Cash flow turns positive before earnings in most cases, if not all cases, and price to cash flow can be used for that also, to cheat ahead a little bit and get earlier onto that revenue slide. So yeah, I think it's a good discussion. If you have not actually sat through the Feraldi presentation, we'll have some links to that and talk about it a little bit later on too, but we would encourage you to do that. All right, let's go ahead and get into our best small companies. Ken, I think am I allowed to talk just a little bit more openly about this with there being, what do we,
I don't know. We got 2 weeks yet, Mark. Are you
2 weeks?
knocking on wood all over the place? Okay.
Okay, I'll knock on wood for you. I mean, that lead.
Remember, stock prices fluctuate, Mark. Okay.
Stock prices fluctuate, and in fact, the gap has narrowed in the last 2 days. So we don't want to spend too much time talking about it, other than to say that we're in good position right now, and hopefully we will remain there. And here's just a quick reminder of some of our favorite sources. There's some of the numbers. Our selections over that time frame have averaged 19% per year versus about 10% for the stock market. And over the last year, now we're at about a 8 percentage point lead. So I'm knocking again on wood, Ken. And this October, we've been basically going through many of these sources. We'll continue on today with just kind of digging in and seeing where ideas might erupt from. Okay, here's kind of the current list.
And Mark,
yeah, go ahead.
I think we want to make it real clear that while we value these lists of fastest growing companies, we're looking for a very particular subset. We're looking for a group of stocks that have relatively small amounts of revenue and are really fast growing. So we can point to companies on the fastest growing lists, like the Fortune list from 2020. We can point to companies there, but they have revenues far in excess of the kinds of companies we're looking for. We're looking for a very specific subset of these faster growing companies.
Yeah, and in fact, I would point out another dimension that we're looking for, and that being companies that are attractively priced.
Absolutely.
We're looking for investing opportunities. I mean, it's one thing to put out a list of a bunch of companies that are growing rapidly, but we want to focus in on the ones that are attractive from an investment opportunity perspective. So that also narrows the field considerably. All right. Any other points on this one?
No, I like the list you're going to show us, though.
Okay, here's kind of where we're at the end of last week. Some of these companies are persisting. Some are kind of sliding down the list. I noted last week that the Missouri Bank had actually fallen off the list. It was near the top of it, but these are the companies that exhibit all those characteristics. Again, let's go through the list. We're looking for double-digit growth. If you send me a company that has a 4 or 5% growth rate, we're going to basically say thanks, but we are really fixated on double-digit growth. We also want a company that is of decent investment quality. And as we define quality at Manifest Investing, I mean, it's a manifestation of financial strength and the consistency that we see with earnings predictability, and also relatively strong growth compared to their peers. So we want all those things. We measure that with the combination of a projected annual return and the quality ranking to come up with this manifest ranking. And that's basically what we're looking for, is companies that are growing at double-digit growth rates, that have excellent quality, ranked amongst their peers with high return forecasts. And that's what you see on the list. In order to make this list, you got to get into the top 1% of all companies at Manifest. We do use that projected return on value, consistent with what Brian Feraldi talked about, to narrow down that list. We want to see double-digit projected return on values also. You can see some cursory upside-downside ratios. We love it when these companies have relative strength indices less than 40, 30, in some cases approaching 20. That's a pretty good deal also. And then some other benchmarks just to kind of compare against. Those Morningstar and analyst consensus estimate price to fair values, anytime you're under 100, you are potentially on sale. Anything less than 100 is discounted. And then the 1 year, just to keep our eye on that 1 year, I doubt the efficacy of those 1 year forecasts, but still, it's good to have a company with a lot of tailwind instead of headwind. Anything jump off the list that you can?
Well, we are going to be making value judgments about where the company is domiciled. We're going to look carefully at companies that are outside the United States. We're going to take into account the industries that these companies represent. We don't want to be overly heavy in an industry that maybe has been beaten up. That's putting too many of your eggs in one single basket when you're trying to put together a portfolio that's reasonably balanced. And you want to also dig a little tiny bit into the current news about these companies to make sure that there's not something bubbling near the top that you've missed as far as damaging to the point where it's going to destroy the company in the near term, because this is a kind of like a contest entry, and we're going to try to measure the performance after a single year. We had one stock like that was just beaten to a bloody pulp because of current news. The news came out after our list did last year, but Emergent Biosciences, I think that was the name of it, right, Mark?
Yeah, Emergent Biosolutions, I think.
Biosolutions, yeah. That certainly wasn't the kind of company in retrospect that we wanted to have on our list.
So I thought it was a sure thing at the time I picked it. Yeah, and there's a couple other things that jump out here. Facebook is never going to make the final list. It's too big. So that one you can disregard. There's a couple others on here that are probably just way too big. They'll fall off and be replaced by some others. All right, so let's go ahead and crank through some. This is one that Kim actually brought to us. If she's not being construction noised out, she follows this gentleman on Twitter. And
Well, actually, it's YouTube.
this is actually from YouTube. Okay.
He has a YouTube and he has a Twitter account, and I heard a lecture by Monish Purbai said that you only need 3 kinds of stocks, because this is what Charlie Munger said, and the one that is the most profitable to me is being a copycat. You find the great investors and see what they're buying, and then you try to figure out why. And Brad here has interviewed Monish also, and he follows what some major big time investors are doing. And so I found his YouTube channel. I found out he was on Twitter, so I started following him. And then a lot of times I can't always watch all these videos with what my current situation is, but I can read all the comments. And this is how I found this actual presentation and this listing of stock. I had known about Terry Smithson. He is the Warren Buffett of England, and he has a fund that has been successful at about a 16% return, and he likes our methodology, also does the same thing, great quality stocks. And so there was a lecture on Terry at Fundsmith and small cap stocks. So I sent this to Mark to see if anything would look really good for our October small cap list that we put out. So I just shared what I found. There you go, Mark, all yours.
Yeah, and Terry Smith actually operates the Fundsmith family of funds. One of the funds is actually focused quite heavily on small and mid-sized companies. And it's only been around for a few years, but it has generated a nice outsized return. And frankly, as you look over the holdings, we'll do that in a second, the conclusion that I come to is that he is thinking a lot like we do, a lot like the citizens of Dodge and Graham and Buffettville and all that stuff, all barking up that same tree, looking for basically high quality companies, whether they're small and medium sized. And here's a look at the Smithson holdings. They are covered on Morningstar. The ticker of the fund, this is actually treated as a closed-end fund at Morningstar, but this ticker will work at Morningstar if you want to track these guys, SSON. It is a British investment trust. but we're just looking over their shoulder, as Kim said, kind of in copycat mode, looking at the types of stuff that has generated interest for Terry Smith and his team of investors. And as you look down that list, you're going to see, again, a British flavor to it, but a whole bunch of companies which kind of fit the mold of companies that we have liked or like at this time. And
I can tell you, Mark, that I found Fever Tree 2 or 3 years ago. And okay, everybody in the audience, this is what you don't do. If you find a stock that you think is going to do well, you need to put it on your list to check it every quarter to see how it does, because I had recognized it had negative cash flow and it had negative earnings per share. And I'm like, well, no way am I going to get that. Well, that turned around real quick, and that stock price has too. And I recognize Wingstop. That's one that Pat Donnelly presented, I don't know, 2-3 years ago.
sure. Yeah, and the Domino's Pizza Group, we'll take a look at that in a second. That's the British subsidiary of Domino's Pizza. So,
Mark, there's a second Domino's on the list. Is there a difference between them?
Yeah, one is the U.S. company. That's the fourth one down, and the one down below is the British separately held company. The PLC stands, I don't know what PLC stands for. I just know it's the British version of Incorporated. So PLC tells you that it's the British version. So all I did was I'm more interested when I look at over the shoulders of somebody like this is what have they been interested in lately. Wingstop qualified along with those two. Here's a quick look at Wingstop's price chart. And we did pick it for our best small company list a couple of years ago. And Ken, you will remember vividly that I had the heebie-jeebies over this one. I mean, retail gives me heartburn to begin with, but food retail.
Well, we both were skating on thin ice with restaurants. We didn't trust restaurants. We didn't trust a new concept to be around for the whole year, let alone to make the most money of any stock that in the pile. But this one surprised us to the upside.
Yeah, and the other one, if you remember, was Popeyes. And
Yep.
I mean, we agonized over Popeyes, and that did come in number one. Yep. over the following year. So sometimes when you see Ken and I make the final selections around Halloween, we are definitely doing it with our fingers firmly pinching our noses, and sometimes you just have to give up on that. I confess I did that a little bit with the banks last year, and boy, was you talk about Mark being spectacularly wrong. But this is a case where Wingstop has kind of come back into favor. You can see that this would have been the period when Smith's group would have been looking at it, and it's actually gone up about 50% since they started accumulating it again, and pretty cool. It's not an attractive buy right now, but it certainly looked like a pretty good call. Here's the Fever Tree. Go ahead.
Dwight is letting us know that PLC stands for Public Limited Company.
Thank you.
So maybe it's their equivalent of corporation or something similar to it. Yeah.
Yeah, it's definitely the British equivalent. You'll see it here for Fever Tree Drinks PLC. Now, I'd never heard of the company. Then I went to tennis last night, and I'm sitting across the table. The ladies drinking a Fever Tree beverage. So you talk about worlds colliding. This is just a quick look on Y charts. You might want to run a stock study on this company. The revenues have been fairly impressively going up. You can see that they have had a little bit of turbulence on that, by the way, would be the equivalent of Section 2A on the lower chart. So they've had a little bit of turbulence there, but if they're going to hang around in that 15 to 20% net margin area, could get pretty interesting. So it's the type of company that probably deserves a closer look. It almost made our short list of companies for candidates. So it's the type of idea that can kind of spring off of a list like this.
Mark, could you back up 2 or 3 slides, please?
To this list?
That one right there. Could you source this list? What is this list? Where is it from? And what's it talking about? What is it telling everybody?
This is actually from Morningstar, and it's a list of all of the holdings of the Smithson Trust. So these are going to be small and medium-sized companies. You find it under the portfolio holdings at Morningstar. And you can see that these guys have some long-term conviction. I mean, they obviously are not doing a whole lot of transacting. Many of the companies on here are still from 2019, and this thing only got started end of 2000.
I'm looking at the list, Mark, and I'm recognizing a fair number of companies that we've covered at roundtables and we've covered at various things. I'm looking at IPG Photonics, MSCI Incorporated, Massimo, Qualys. There's Rollins. There's quite a number on this list. So this might be a good source just for ideas for some of the folks that are looking for ideas to begin to pad out their portfolios. It's a nice list of possibilities. Cognex is another one.
That technology one keeps springing out. I want to know what this one is just because I want to know what it is. I do not know. And Rightmove, we had actually talked about at one of the conventions over the last couple of years. And that's apparently done pretty well from the time it's presented. I want to go back and take a look at that. That is a real estate company, much like Zillow, only in England. And they've done pretty well. So yeah, this is again, this is demonstrating the concept. And we're going to do this in spades next week as we take a look at Brown and some of Kathy Wood's stuff and, you know, the successful small company funds that are out there, looking over the shoulders of some people who seem to know what they're doing and are interested in the same type of high quality small companies that we are. And again, it's used as a source of ideas to study. I would probably, Ken, suggest that, you know, you look at the ones that have not been doing so well here lately. Here's another one down here. Maybe we figure out what these guys do. There's probably a hint there in the word engineering.
Yeah.
So,
by the way, Mark, this is your Temenos company.
No.
Sorry, here, go ahead.
Go ahead, Sean.
That's your neck of the woods, Mark, with engineering. I'm sure you'll figure that out a lot better than this nurse will.
Sean, you have a comment on Temenos?
Yeah, Temenos. It looks like it's a sort of a fintech banking company, banking software.
Could be worth taking a look. It looks like it's done pretty well, though, so it might be a little bit out of the price range right now, but it's had a pretty good run here lately. Thanks, Sean.
Well, Rightmove makes me look interesting when their 1 year return is only 5.73% and a PE of 28. It's not like 80 of a PE.
Mm-hmm. So interesting stuff. Again, looking over the shoulder. Here's that Domino's question for you, Ken. This is just the British part of Domino's. And again, fairly decent looking picture. They've had some rough times on the profitability side, probably COVID related, that you see down here. But a fairly decent sales growth profile. Again, approaching double digits anyhow. So it could be worth
Mark,
it.
I don't know if if it means anything, but it took the Wolves 10 years to get over their bad purchase of Bob Evans when they first started. And then they went into Cheesecake Factory, and the company, you know, immediately went way down, and so they got out of that. The Wolves just basically in the last year and a half has gotten into Domino's. So I hope that doesn't signal any kind of a you know, cover your heads and run for the shelter. But we're sitting with a full position in Domino's Pizza right now.
Okay. Well, you guys should have listened when I brought up Panera.
Well, we should have. We did listen with Buffalo Wild Wings, Mark. That was a restaurant that we bought that was a success.
All right. And one of the other things we want to talk about here, unless you've got anything else on that subject, Ken.
Nope.
All right. Let's talk a little bit about you know, a place like Twitter as being an obscure source of ideas. And just this morning or earlier today, Tom Gardner of the Motley Fool actually put out this question. And again, the trivia for you guys out there, the Motley Fool, one of their first newsletters that they began publishing was Hidden Gems. And you guys should know that was actually brought public at a national convention for better investing, probably over 20 years ago now. But Tom basically made a presentation at that conference, and he talked about how the types of things he looks for in small companies. I think that it rhymes and resonates with a lot of what we do. And I've always thought of the Hidden Gems newsletter as a source of ideas, as well as their other newsletter, the Stock Advisor, as a source of ideas. We'll be covering that also in greater detail probably next week. And he put out this tweet this morning, and I'm not sure how many responses he's got, but it's probably up in the 400 or 500 range at this point. And the names come out of the woodwork. And some of them are legitimately good things to dig into. Others, there are people out there that are promoting some of this stuff. Some of it is definitely penny stock land. But some of these actually jumped off. This is a company that's already in manifest coverage. It's an advertising company that's making some pretty good strides. The solar integrated roofing keeps popping up. Might be fairly early, but probably not a bad idea for a watch list. Sean, did you say that's one that you've actually looked at a little bit closer?
It was one that popped up on my list. I did not get a chance to really look into them deeply. It was just a preliminary thing.
Well, you're probably the most qualified to compare Tesla versus these guys.
And you knew exactly I was going to go there, and that's definitely something I'll keep an eye on, because I'm trying to work out something that I don't know. I don't like his price to hope ratio earlier on in the non-core core graph, and I'm just curious if you could, based on what kind of tech is coming out, that if you can work out whatever current competitors have of the market. If you're able to work out what new companies could potentially grab away from current competitors, if that makes any sense. But I'm definitely going to be looking into them, because any competition is good competition.
It probably does make sense, and Ken may want to weigh in on this one also. You can think back to the early days of Amazon, when basically the pricing was basically put in place to capture market share. And they probably made quite an investment to do that. Other companies have done similar things. So, yeah, that there's probably some type of an allowance in an early stage company to account for, attempting to capture market share by concessions on pricing.
I think it might be interesting also, Mark and Sean, to take a look at the development of the computer market. Starting in the late 70s and moving through maybe the end of the century, where there were so many different strategies by so many different companies attempting to grab market share and grab loyalty. And many of them seemed to work, but in the end, it came down to what's best now, and there didn't appear to be as much loyalty as computer companies thought there was going to be. And I'm wondering if that will carry over to the electrical vehicle markets as well, that you might stay loyal in the beginning, but when push comes to shove, a lot of folks make large purchases based on a lot more things than just brand loyalty.
Yeah, those durable goods definitely have a different loyalty to them.
Yeah, but it was very interesting to watch the companies specifically do things. Apple, for example, was very specifically aimed at capturing the youth, and their business model was, if we can convert the young folks to love Apple products while they're in 5th grade and 6th grade and early junior high school and middle school, if we can convert those kids, we'll have them for customers for life. Well, it turns out that didn't come to pass. They flooded the schools with Apple computers and computer labs and all kinds of things, and yet the PC was what finally took root in the schools. And a lot of it had to do with just sheer cost per machine, cost per maintenance, and things like that. So,
and Dell definitely took them on too.
Yeah,
well,
but if I could still invest in Apple back then, I still would.
Well, I would urge you to look at a long-term graph of what Apple stock did, because while there are a lot of people that would have liked to have bought 1,000 shares of Apple back in the late 60s, when you could have bought Apple for a very, very reasonable price, you had to have nerves of steel to last out about a 10-year period when Apple almost went out of existence.
Oh yeah. No.
So
Yeah, that was there too.
yeah, it
Wow.
was a very difficult time to be an Apple investor for a long time at one point.
Yeah,
Mark, in fact, Mark and I have shown on slides a long-term history of the price of Apple and how it wasn't just a nice, simple ride up the hill on a roller coaster. It was a series of ups and downs, and you had to have staying power if you, it probably was better to sell and come back in and sell and come back in a couple times, depending on what they were doing.
Oh yeah. No,
So,
I'm looking at it right now, Ken, and you're right. I mean, this is for compared to today's costs and all the splits they did and all that, but it goes from 10 cents down to 5 cents, back up to 70 cents or 7 cents. And yeah, that's all throughout the 80s that occurs. And you really definitely had to have some steel. I mean, you're losing 50% of your stocks there.
absolutely. And if you had a
Wow.
big holding, so
I will say though, if you look at the line today, right now on Google Finance, from the early 80s till early 2000s, it's just a flat line. It looks like a flat line on it. But still 371,000% up all time.
I'll tell you that I do own 5 shares of Apple that come from 1968.
Oh my
Whoa.
gosh.
Those were inherited shares, but I wasn't investing then, Mark. Okay,
Was it Forrest Gump by chance?
Forrest Gump. Yeah.
that means you're buying dinner again. All right.
Right.
All right, so I would encourage people to just kind of scroll through those. A couple of these are much more interesting than others. The Transmedics, by the way, is the transmission of organs for organ donors to people who need them. Interesting company that definitely we all want to cheer on. Adamas Pharma actually has a COVID pill that they're working on to take an oral pill. But some of these are pretty interesting. Gladstone Land it's actually a real estate investment trust classified as an industrial for farmland. I just kind of put that one on there. I'm kind of fascinated by Bill Gates buying up all kinds of farmland in the United States, and I just read an article about a huge solar complex being put in down in Indiana on a bunch of a huge number of acres, and some of that is going on. So maybe there's something there. I have this closely held theory that Gates is probably thinking about some of that type of stuff. So none of these actually made the list. Some of them are better than others, but they can be the type of stock to add to a watch list. Tellurian is a liquefied natural gas play. And
Mark, I see the description for RAP at the bottom of the slide there. We sat, I don't know if you remember, but we sat at an investment club meeting about a year ago and listened to a policeman's wife present this stock.
Did you really?
About 10 or 12 minutes of discussion about RAP.
Well, I just put it in there because I thought it was just a sign from above that I needed to wrap up that list. I'm here all week. But yeah, just the things you discover when you start tinkering with this kind of stuff. This is actually an alternative to tasers, and I think of it as, you know how they're duct taping the passengers to their seats in planes. Well, this is kind of the same thing, only with Ebola, not Ebola, Ebola. All right, it just struck me as, all right, I'll move on.
Well, the woman that was presenting this stock, Mark, her husband had just come home from a conference where they were demonstrating different ways to restrain people that were becoming irritated or violent, everything without without shooting them and without tasering them. And this one appeared to be coming from a public company, and she brought it to her investment club. It'd be interesting to look at how it actually performs, whether it has any earnings and how it's doing.
Yeah, it's a small company, and it's actually made up of a bunch of executives from the Taser company, Axon. But lest any of you think I don't take the subject seriously, I think this is one of the more serious subjects that we face. Giving the police what they need to de-escalate a situation is a really good thing, and I say that as somebody who lives near an area where a guy wielding a rake was shot 8 times. So it's a serious desire. Here's one that Kim actually reminded us about. This one came pretty close to making the list. It's a company called Meritage Hospitality. Not a stranger to us. They're out of Grand Rapids, Michigan. Bunch of franchising, kind of down the flyover part of the United States for the most part. But this is an interesting study also. Ticker symbol MHGU, and it came pretty close to making the list. And we actually know some of the principles that are involved there.
Yeah, and it came out with the last couple weeks. I think that they've signed a contract with Taco Bell. I think it's Taco John's, that they're going to help with another like 200 Taco John's.
Okay.
It's important to make the point, Kim, and I think that I'm right, that these folks own a certain number of Wendy's operations, for example. They're not the owners of the Wendy's company, but they own a number of Wendy's restaurants as franchisors, correct?
That's correct.
Correct, they do. And the company of Wendy's only allows you to own 400, and they're getting to the point of 400. So to diversify, they're getting into Taco John's.
Okay. Good study. Again, that kind of came out of the woodwork. And then this one is a tip of the hat to Matt Spielman. Torch is not public yet, but Matt has promised that he will keep us definitely on the cusp of that one as it comes public. So it was theoretically this year, but not yet.
If I hear these, I'm like, these are all foodtail and real and foodtail and retail, all the things that you don't like.
We still want to know about them. All right. So here's the list as of today. From top to bottom, we've taken out some of the higher cap companies, and this is the kind of list that Ken and I will be using to whittle down to the final 20. Again, limiting the geographic exposure, limiting the sector exposure when it comes to financials, that kind of stuff. And it's a pretty good shopping list so far. Look forward to doing that. We are going to do that, by the way, on Saturday morning, the 29th, on a live broadcast. I think, if Ken and I can figure that out.
I think it's Saturday the 30th, Mark.
Well, okay, 30th.
Picky.
Yeah,
Well, we don't want
Friday
him to
the
show up a
29th.
day early.
The 30th, all right. I'm trying to keep that stuff straight. All right, it's the cold medicine, people. It's the cold medicine. Just a reminder that we do archive all of these sessions, including the expected returns reviews, roundtables, and all of those webcasts we've talked about. The Successful Investing 3 is all there, along with 2 and 1. And we are currently working on putting together Successful Investing 4. Quick reminder that the link to Brian Feraldi's presentation is in the This Week Update, and you can find it just simply searching for it on YouTube also. And then, Ken, here is our reminder that Successful Investing 4, unaffectionately known as the COVID Cancellation Conference number 4, is coming on the 10th and 11th. And would you share some thoughts on this, please?
Yeah, here's our class schedule, folks. These are all brand new classes, even though some of the titles might sound a little bit familiar. They've been completely rewritten and updated. And we're coming at some of these from a completely different viewpoint. Our stock panel has been moved to the evening at the request of lots and lots of our audience that would like to come but found it impossible to come during the afternoon. So our stock panel will be Thursday, November 11th. If you haven't already received an email with this information, including the registration URLs, then drop a line to nkavula1@comcast.net. That's NKAVULA1 Comcast.net. Natalie will send you the entire document that has clickable URLs. And if you want to be on our reminder list, be added to our list, she'll do that as well if you make that request. We hope to have a lot of you there. We've had great success attendance-wise with these conferences, and we have a lot of fun doing these things. We're also soliciting questions for our 20 questions class, which will be held Wednesday afternoon. Myself and Cy and Mark, we're going to sit down and try to answer some of the most basic questions that you have about investing and about investment clubs. Between the three of us, we probably have 100 years experience in dealing with these types of issues. And if it's not 100, it's darn close. And we'd love to get the information out there that makes sense and that helps you run better clubs and become better investors. Just send your question to mark@manifestinvesting.com or to kcavula1@comcast.net. That's mark@manifestinvesting.com or kcavula1@comcast.net. Send your question. We'll try to include it. We're going to run this for about an hour and a half, and we're going to try to answer as many questions as we possibly can. Our goal is to hit 20 or more during that particular time session.
Okay.
So I'm kind of excited about this lineup, Mark. I think that they're new and fresh, and we have lots of things to talk about that we haven't talked about before in any of our other classes.
And we do have a pretty good record on providing some ideas for further study, so we'll certainly be talking about that. And those of you that are frantically writing down numbers, all 4 of these links will be up at Manifest under the event column later today, so you can just click through there. All right, here's our appendix presentation of the Groundhog contest, and since my name's on here, I still don't care. Although I am in this, I'm in number 14. I'm part of the team that made those picks. But other than
Hey,
that,
we'll take anything we can get, right, Mark?
always. But Ken is free to gloat about the Mid-Michigan Model Club being number 5, and he's also got his individual entry on there along with a few others. So he's doing the rooster strut in Mid-Michigan these days.
Well, it hasn't happened for a lot of years, Mark. Okay, I got to get that percentage of total return up there, up a little bit higher than it is on that graph. So,
and I guess the one thing I would point out, first of all, wonderful names up at the top. They're making a heck of a good run. The other thing that I do like to point out is this gentleman here, and we'll be talking more about him next week here at this session. He was down around 100 a couple of months ago. So that gives me hope. All right, so you can see the averages, you can see the returns. Kathy Wood is still stuck in 136th place. That's not a knock on Kathy. We're going to talk about her too. Not a knock on Kathy whatsoever. She's an awesome stock picker in that realm that she operates in. Okay, and so with that, we're going to sign off with a photograph. Any guesses on that location and that bridge?
Is that down by the Florida Keys?
That's a good guess. Got to think the other end of the country.
San Francisco Bridge?
It does look a lot like the Golden Gate, doesn't it? But that happens to be the Mackinac Bridge between the lower and upper peninsulas of Michigan. And the photograph was recently captured by a friend of ours at Better Investing, Mark Stevens. And that's kind of a shot that a photographer dreams about seeing during their lifetime. So it's quite a shot.
I stayed quiet, Mark, because I recognized it immediately, but we get a lot of questions from friends that we have throughout the country about where the heck is there enough water to have a bridge this big in Michigan.
Yep.
So, this is one of the longest suspension bridges in the world, folks, and it's sitting right in the middle of our country.
You know, I think you should show this to your grandson, Ken, because he almost went to college at one end of that rainbow.
He almost went to school about an hour north of the North End, right, up
Yeah.
in Sault Ste. Marie, right. So,
All right, so good stuff. So with that, I think I'm going to go ahead and shut down. Any closing thoughts, Ken or Sean or Kim?
are we going to stick around and answer a few questions here, Mark?
We certainly can,
Great.
as long as my cold medicine holds up.
All right.
All right, I'm going to go ahead and shut off the recording. Thanks, everybody. We continue to churn on our best small companies for 2022. Thank you.
Well, first of all,